We've had numerous indications from inside the Eurodollar system that China's dollar shortage has reignited in a big way this year. Starting with its persistently weak currency that is not about interest rates and interest rate differentials. But now China's dollar shortage has gotten to be such a substantial problem, it's showing up in bank and bond data inside of China and in a way we've never seen before. We can literally see it exploding in a critical bank funding sector. At the same time, earlier today, we get a surprise cut by the PBOC. Then China's banking system followed just a short time later, reducing credit rates, showing just how anxious authorities in Beijing are becoming. So why isn't anyone talking about this dollar shortage? Because according to Jay Powell and the Fed, there can't possibly be a dollar shortage with all these trillions in bank reserves floating around, and certainly not where it comes to the biggest foreign dollar user on the planet, China. Yet, here it is surging in 2024, and right when the Chinese economy and its banking system had faltered badly too. Imagine that. The mainstream keeps trying to say China's currency is about interest rates, in particular the Fed's policy rates. No, CNY down equals funding issues in the Eurodollar system, and they aren't impacted by the Fed one way or the other. You only need to connect a couple of dots to see what I mean, and the Chinese just reported a gigantic dot. One that's so unmistakable, it's showing up in a big way in the bank data. So we're going to go over all these dollar shortage dots. We're going to make some connections. Plus, we're going to connect them to what the PBOC did in hurrying its interest rate cuts, because the background behind those cuts are related to everything we're going to talk about here as well. As we know, interest rate cuts, I just talked about in a video this weekend, it's all superstition. But it's superstition that has a specific purpose. Before we get to that, though, let's back up and do a little bit of background on currency swaps. It isn't really that difficult to understand, at least conceptually, what's happening here. If you are a dollar provider, which means you have spare dollars to lend somewhere around the world, you end up lending those dollars in a currency swap, and you get in return foreign currency. Now that you have foreign currency in your hands, you take that foreign currency and buy some kind of financial asset with it, hopefully something safe, with a decent enough return to add a little bit extra return to lending your dollars into the swap market. The more difficult it becomes for currency borrowers in the Eurodollar system to borrow dollars from providers, the more they have to pay an extra premium to do so. That means they're incentivizing dollar providers to provide dollars into the system. As a dollar provider, that means you get a higher and higher return in order to provide dollars, which means you care less and less about what's on the other side. So you provide dollars, and in this case, you get China's yuan back. And you don't really necessarily care about what kind of financial investments that you might reinvest those yuan proceeds into. You're just looking for some kind of safe return, such as, say, short-term Chinese bank debt. So as you're providing dollars to increasingly desperate Chinese dollar borrowers, you're getting paid more on the dollar providing than you really are on the investment in yuan. So the more we see this happening, where overseas dollar providers show up in local currency and bond markets or in bank funding markets, the more we know that some parts of the local system, in this case the Chinese system, must be desperate in order to pay more to acquire dollars, such that these foreign dollar providers, these overseas holders, are showing up in a big way in the local marketplace. And that's just what we've seen in China, really going back to last September, October, and really November. So according to Bloomberg just today, overseas institutions' outstanding holdings of Chinese negotiable certificates of deposits reached 972.6 billion yuan in June, at least according to Shanghai Clearinghouse data. That made up 22.5% of their overall China bond holdings in the month, according to the central bank on Friday. Now, these NCDs, or negotiable certificates of deposits, are short-term debt sold by banks with maturities up to a year, and they've been a popular home for overseas investors looking to park the premium they get in swapping foreign currencies into yuan in the onshore market. And they say foreign currencies, and they talk about premium. It's the premium you get to provide dollars, because dollars are the global reserve intermedium. So even if the Chinese want to acquire some other currency, which they really don't, They're still going to swap into US dollars to intermediate through them because the dollar is the reserve currency denomination. You want to access the global marketplace, whether it be merchandise or finance, you got to go through the Eurodollar system, which means you got to get into the dollar system somewhere. And if Eurodollar providers are increasingly risk averse towards you and those like you, you're going to pay more and more to do so. As I said in the intro, we see this already in the falling yuan currency. But now, as Bloomberg is reporting from the Chinese government data, we're seeing it in the other side of the swap in the local bank bond market, negotiable certificates of deposits. Going back to Bloomberg one more time here. While yields on one-year NCDs from Chinese banks with AAA credit ratings have fallen to just under 2%, overseas buyers get a sweetener from onshore traders paying to swap their yuan for dollars, bringing their expected yield to about 6%, at least according to data compiled by Bloomberg. And they're downplaying the real incentive and the real motivation here, because of course they are. It's not you get a sweetener from your swap of dollars into yuan. That's the whole point to begin with. From the perspective of those in the yuan marketplace, they desperately want dollars, and so they are willing to pay a higher and higher and higher and higher premium to do so. It's not a sweetener, it's the whole point. As far as from the perspective of the dollar providers, if they can get a couple percent from a one-year negotiable CD from a Chinese bank, fine. But they're making more on the dollar providing than they are the 2% that they might get from the yuan negotiable CD. It's all about the dollar shortage. And we see this in a number of ways, including from the swap market. Now, to be clear, the banks that are issuing negotiable CDs are not necessarily those who are borrowing dollars in the swap market. That's largely the policy banks who are redirecting and redistributing the dollars that they borrow in the swap market to try to prop up China's weakening currency. So it's an indirect process where China's policy banks are swapping dollars for yuan, taking those dollars that they get and redirect them into the local onshore currency market to more increasingly desperate dollar borrowers in that local market. And from the other perspective, from the other side, the dollar providers who are increasingly risk averse demand a higher return to provide dollars, get that higher return from Chinese banks who are doing this on behalf of the PBOC to prop up the CNY. And so they get a higher return from their dollar providing activity and then use those yuan proceeds, because the yuan proceeds are the collateral for providing dollars. They use those yuan proceeds to purchase a very safe and liquid investment in China. It doesn't pay all that much, just 2%, these negotiable bank CDs, AAA rated, because that's what you want on the other side. If you're making money providing dollars, you don't need to make a killing in the yuan market. But the point is, this is all about the dollar shortage, the premium that China's banks are paying to acquire dollars. And no one ever asks, why is there such an enormous dollar shortage to begin with, and why does it appear to be getting so expensive? But that's a question that we aim to answer at Eurodollar University with our memberships and subscriptions. You never hear about a global dollar shortage like we're seeing right now in China, but that's what these are all about. I have a daily deep dive to dive far deep behind all the topics I bring up here on YouTube, and I dig deep into the dollar problems in China quite a lot at the DDA. We've got memberships with tons of videos on everything from the basics, money and financial concepts, even QE and QT that you're not going to get anywhere else. Plus our daily briefing, what keeps you up to date on everything that's happening in money and macro. We are in the final days of our anniversary sale, so this is your last chance to get some of our best prices that we've ever offered on memberships and subscriptions. And I also want to remind you, in addition to the anniversary sale, I'll be hosting a live stream here on YouTube tomorrow night, July 23rd, 6 to 8 p.m. Eastern Time, where EDU members and subscribers will be able to ask me a whole bunch of questions, as well as the guests who are going to join me. I've got some really big guests coming. All tomorrow, July 23rd, 6 to 8 p.m. Eastern. Check out our website, eurodollar.university, for the final days of the anniversary sale, as well as details on tomorrow's live stream. I hope I can see you there. Now, I talked about this a couple months ago, where the Chinese were reported to have sold a record amount of U.S. Treasury and agency debt in the first quarter of this year. We don't have the second quarter update just yet, but it's going to likely look pretty much the same, because, again, we're seeing all of these symptoms of dollar shortages, from China's falling currency to now these negotiable CDs being owned A lot of them being owned by overseas dollar providers who are parking funds, the collateral that they get for providing dollars. The other side of that is the Chinese government in some fashion selling treasuries and US dollar agency debt in order to raise proceeds to help alleviate this dollar shortage problem that they have. This is another angle, another dot to connect in the dollar shortage story. The Chinese are not, as I said in a video a couple months ago, they are not selling treasuries because they hate the United States or they hate Biden or they hate something about the dollar. They're not trying to replace the dollar. They're trying to live with a condition of the dollar, the Eurodollar system, that isn't providing them the dollars that they need at the rate that they need or in the quantity that they need in order to continue to do whatever it is that China is doing. So the increasing dollar shortage shows up in their selling of U.S. treasuries as well, which is why China tends to sell its treasuries and agency and U.S. dollar assets at the same time we see all of these other indications of Eurodollar shortages, including falling, compressing negative interest rate swap spreads, which I talked about in a recent video too. Negative swap spreads are, first of all, an indication that people in the US dollar market are increasingly worried about something happening, which will push short-term money rates lower, something like a deflationary event. At the same time, a negative swap spread also suggests that Eurodollar providers, bank dealers, require increasing incentive and premiums and returns in order to do the dealer activities like writing swaps or providing dollars and redistributing dollars into China. All of these things connect together, one dot after another after another. Now, behind both of those, the Chinese also reported a record merchandise trade surplus for the month of June. Just a couple weeks ago, they showed that exports were rising in US dollar terms. Export rose at 8.6% year-over-year rate at the same time that imports fell by 2.3% year-over-year. The net result was China's merchandise surplus of just a little bit less than 100 billion, which was a record. And it wasn't because exports were soaring, exports were up, there was minimum growth in exports, but it was because they were balanced by a reduction in imports. And this is something that we've seen before. When China confronts a dollar shortage situation, such as in 2018 and 2019, or really 2015, we saw it then in a big way. Authorities in China restrict the amount of imported goods that they're willing to buy because they're trying to conserve the amount of dollars that they have available. So if you have more exports than imports, you've got more dollars coming in through the export sector, and you're hoping that those dollars, because there's more of them, find their way into the dollar funding markets to help alleviate the shortage situation that China's financial firms are finding from the Eurodollar perspective. It's a pretty complicated system where there's a wide variety of means available. It's not just about merchandise trade and surpluses from selling goods. And as long as Eurodollar providers, these dollar providers in the Eurodollar system, become increasingly risk averse, then it almost doesn't matter how big your trade surplus is. It does help, but it isn't the antidote to the Eurodollar problem. And the Eurodollar problem is really about, in big picture terms, risk aversion. And it's not really a big mystery why dollar providers would be so risk averse in providing dollars to China, because everything about China these days says stay away. Huge risk, enormous risk. I mean, just look at the recent statistics we got last week or the week before. China's GDP among the lowest in its history, quarter of a rate. It was more like a lockdown than anything else. The big three statistics, industrial production, retail sales, as well as fixed asset investment. Industrial production was the best of the bunch, and it wasn't all that good. Retail sales continue to be just downright ugly. No internal demand. And then the credit statistics, which I keep referring to. China's credit statistics, the banking sector. Talk about risk aversion. China's banks themselves are risk averse when it comes to the Chinese system. So of course, outside banks are going to be increasingly risk averse about providing foreign currency into a system in which the local banks aren't all that enthusiastic to participate in either. So there's not really that much of a mystery here to unpack about why dollar providers would demand a higher and higher and higher premium in order to provide dollars. With all of this weakness going on, with all of these questions surrounding China, last night the PBOC unexpectedly cut its 7-day repo rate. It didn't cut its medium-term lending facility, MLF rate, which had been its main benchmark, because as I've talked about before as well, especially in deep dive analysis, China's PBOC is transforming itself because it doesn't work. Its monetary policies aren't really monetary policies anymore either. PBOC last night cut its 7-day repo rate, unexpected. Not many people had this one coming. And then a couple hours later, maybe an hour later, Chinese policy banks, all the banks that get together for the LPR panel, decided they were also going to cut the 1-year LPR as well as the 5-year LPR. And by LPR, I mean the loan prime rates. Now, these rate cuts, they don't work any better than they work around the rest of the world. They're mainly superstition. But since the PBOC is transforming more into a psychological-based central bank, keep cutting rates as a matter of superstition to hope that maybe it inspires someone somewhere to do something positive in the real economy or the banking system if they're getting really lucky. So with China's authorities becoming a little bit more panicky here, dollar shortage indications continue to show up everywhere. Of course, they're going to show up in the currency exchange value too. China's Yuan exchange value as of earlier today, just before I started recording, 727.40. It's right back down to about where it was on July 10th, which had been the previous low. And then we had the U.S. CPI report that came out on the 11th, along with the Bank of Japan intervening. And I've talked about before how the China's Yuan and Japan's yen have traded very closely together. So when the government of Japan intervened in the yen, that also had a spillover effect in the yuan. But since this is not about interest rates, it's not about interventions, CNY finds its way lower anyway. Even as we get closer and closer to the Federal Reserve's rate cuts. China's dollar shortage is normally hidden away in the shadows of the Eurodollar system. We can see it at times when the currency goes lower, CNY down equals bad. We can see it in a couple other ways, but it doesn't normally necessarily show up in the onshore banking system like it has over the last 7 months or so. So dollar providers are providing dollars to Chinese banks that are increasingly desperate to borrow them to help prop up the yuan and really redistribute those dollars into the starving local marketplace in China. Well, meanwhile, the dollar providers who now have yuan as collateral for providing dollars are increasingly investing that collateral, that yuan, into these negotiable CDs among Chinese banks. That's what's exploded. The more desperate Chinese dollar borrowers are, the more they pay a dollar premium, the more dollar providers show up in domestic markets. And it all goes back to these fundamental characteristics. It's not going well in China, just like it's not going well in Japan. And the dollar shortage reflects these fundamental properties: money, economy, and finance. The problem is that it's not just about China. China's big issues go back to its real estate problem, which goes back to the fact that the global economy never recovered from 2008, and then it suffered another blow in 2020 and 2021. It didn't recover. It was a price illusion. So the dollar shortage activities that we see and all the data that's now showing up and showing this is also a reflection of the risk aversion, not just about China, that's just the weakest one, but risk aversion that's going to be applied globally. Market participants, whether they're the Eurodollar providers or the local currency system and the participants there, they are literally not buying the recovery and reflation story in China or around the rest of the world. Risks are growing, and they are demanding to be paid more because of it. Chinese government reported just ugly macroeconomic statistics, but even more alarming was the bank data. I talked about both of those at the video link below. Final days of Eurodollar University anniversary sale. Check that out at our website. Hope to see you tomorrow on the live stream. Thank you very much for joining me. Huge thank you to Eurodollar University members and subscribers. And until next time, take care.